The content provided by Full Throttle Forex and or subsidiaries of Full Throttle Forex is for informational purposes only. Full Throttle Forex and any or all of its members are not qualified to provide trading, financial, investing recommendations, suggestions, or advice. In no way are the speakers or guest speakers performing in an advisory capacity. You must conduct your own research and analysis. This allows you to be completely responsible for your decisions on whether you should trade in the Forex marketplace, either with software trading or manual trading strategies. Your attendance on any Zoom, call, or social media live event is an acknowledgement that you agree to the above statement and that you agree to hold harmless Full Throttle Forex and its subsidiaries. Okay, so I'm going to stop the share. We're going to use a little bit of the chat box today because we want to make it interactive. It always makes it more fun. Because after all, this isn't about Ryan and I, it's about all of us on the call. So if anybody saw my graphic that I did for our Lunch and Learn today, can you please tell me, since 905.27 is not a radio station on your FM dial, can anybody tell me what it is? Does anybody have any idea? Who?
I have no clue.
Yeah, you don't know?
I don't know.
Oh, right on. I stumped the genie. Nobody knows. Oh my gosh.
Never a shortage of new things to learn, especially in the Forex arena.
Especially today. All right, nobody's answering. No idea, no idea. Fibonacci. You've stumped Ryan, that's good. I don't know. Maybe I'm the only one that found this article. All right, so 905, and Ryan will want to expand on this because he's great at taking these things and extrapolating. 905.27 are the number of points the Dow dropped this morning at 8:30.
Oh, yeah, it's down 945 right now. You know, I was gonna say, hopefully you're telling me that speaking of genie in the bottle, that will be the new price of USD JPY.
Yeah,
I'm
right.
Really nice sell trades right now, and if they can get down into the 109s, I'm buying a steak dinner for RDOC and A to the D. I'll tell you that much.
No doubt. So look at this. The Dow dove 3.12% this morning, 905.27, and it's continuing to dumpage. Fire sale, right? If you don't know what a fire sale is, watch. There's a movie with Bruce Willis in it. It's a different kind of fire sale. Not only that, but the S&P fell 2.8%, 96.63 points. The NASDAQ, the composite NASDAQ, mostly with tech stocks, right, fell 3.6%, 341.72. And on top of that, as much as the U.S. dollar was just crushing it, okay, the U.S. Treasury 10-year fell below 1.37% for the first time in forever. That would have been 2016 in the Brexit vote, where it hit 1.32, an all-time low. So it's low. So
Alan, did you read an article that had that info?
I did.
Did it talk about the yield curve inverting again by chance?
It did not.
I'm guessing it did. If the 10s dropped that far below, 10s and 2s probably inverted, which is another, like, for people that are really heavy hitter institutional traders, that is like one of the most, never gets talked about in the retail world, but in the institutional world, if you're really doing deep dives, that's a massive indicator of sentiment of the heavy hitters, the $1 trillion traders.
Yeah, the $1 trillion traders.
Bond yields, when the short-term and long-term bond yields invert, it's a really big deal, actually.
And so and most of that is due because of the coronavirus has a lot to do with it. Oh my gosh. In this article, they talk about more cases that have come out of China. So the market was reacting over the weekend. That's why it dropped so quickly this morning. There was concerns over the weekend. But Ryan, when the Dow dives like that and the S&P follows and the NASDAQ follows, what does that mean for our U.S. economy?
Yeah, it's so funny that we didn't talk today, man. And without even talking, we're on the 100% same sheet of music, right? You used a different kind of a term for what I used to be, familiar with as a ditto machine, right? Last week.
Mimeograph.
That was before we had photocopiers, right? They made dittos. It was a ditto machine. Anyway, we were like on the exact same page because look, we talk about these different things to help everybody have a point of reference so that they're not just, you know, a passenger on the bus. Like I love that Nan put that she's out of her drawdown. Well, I'll tell you why. Because you're in Euro USD buy trades, and the USD is getting decimated now. It's having its own retracement of what we thought was like this, you know, unstoppable US dollar run up. And it is crazy how rapidly these swings can happen, not even necessarily in a currency pair per se, but in an entire economic outlook. I mean, it didn't take much, right? Negative PMI numbers on Friday that were dramatic. We already talked about that on the Saturday session, combined with, you know, the coronavirus having a larger level of uncertainty. And as we've talked about many times before, markets don't like uncertainty. And where we're really seeing so just like the US dollar index is not anything to do with a currency pair per se, but it is a wonderful leading indicator. You know what else can oftentimes be a leading indicator is what you just talked about, Alan. It's our major indices, right? So for those of you guys that maybe aren't familiar, the Dow Jones Industrial Average is what's known as an index, right? And when you have multiple indexes, we refer to them as indices, okay? Which is not indecisive, by the way. Multiple indexes referred to collectively are indices. And so when the major indices are you know, there's confluence, they're all doing the same thing and doing it dramatically, that is a massive leading indicator. And so here's the deal. We have a chink in the armor. There's dramatic signs of weakness in the U.S. economy, which leads to signs of weakness and here's where it comes from, by the way. So let's unpack this a little bit. It really is mostly fears of the coronavirus, because that's going to affect the profitability of U.S. publicly traded companies. U.S. equities are threatened, okay? Now, think about the stair steps, right? I don't have an economics degree, okay? You don't need one to make sense of this stuff. So, if the strength of U.S. companies looks like it's weakening and weakening drastically because of the hindrance of particularly their export businesses, right? And really import and export. But coronavirus is a larger concern outside the United States, and it's causing employees not to go to work. It's causing shipments not to be shipped out. It's basically putting a major slowdown to the world economic machine. And you know, we talk about this all the time as it relates to most people on the planet are participating in Forex, whether they realize it or not. Because, for example, a behemoth of a company named Apple, that is a US-based company that operates basically in the sense of US dollars because they're US based. Well, guess what? They import stuff from all over the place. And so now if those imports are slowed down, or if their retail sales are slowed down because their employees aren't showing up at the Apple store because they're trying to avoid coronavirus, right? You get this big ripple effect. And now that's spread so broadly throughout the major, you know, kind of the major US corporations that they're all reporting revisions to their earnings forecast, right? This is where it all starts. If you guys want to understand the last, you know, really the last 24 hours, and quite frankly, even last week, and why were people in such massive drawdowns? Well, because initially the US companies were sort of shrugging off coronavirus, like, it's not going to bother us. It's not going to phase us. And then what you had was on Friday, you had PMI numbers getting really weak. And then you also had several major corporations like Apple saying, this is a bigger deal than we thought. We need to revise our forward-looking statements, right? Publicly traded companies are legally obligated. They have a fiduciary responsibility to give forward-looking statements. It's part of their SEC compliance, okay? And so when you get companies, and some of the biggest ones in the world, starting to revise downward their forward-looking statements, that's a problem. And you're seeing the manifestation of all of that basically today. The first domino fell on Friday, and then things, you know, obviously piled on that a little bit over the weekend. And so here we are.
Yes, for sure. You know, you mentioned something in your explanation that you were just giving that I want you to expand on just a touch. Because actually I thought about doing a little bit of a lesson on this today, and then I passed on it, maybe because it's going to take me more time to put together the lesson than I did. But you said is a leading indicator. All right, guys, there are two types of indicators. Well, there's more than that, but there's leading and lagging, right? And you hear us talking about that. Leading indicator, that is a thing. Lagging indicator, that is also a thing. Ryan, can you explain to everybody what the difference between the two are?
Yeah, so a leading indicator, something that's going to give you a precursory, like a forward-looking insight, okay? Meaning the other things will follow that leading indicator. For example, last week, the US dollar index was just continuing to make new highs. That was the leading indicator, and every currency pair that was a US dollar denominated currency pair was following that leading indicator, meaning if it was NZD USD, you wanted to be in sell trades because NZD was losing against the USD. If it was USD JPY, you wanted to be in buy trades, right? If it was Euro USD, sorry everybody, you wanted to be in sell trades last week, not buy trades. And so that's what we mean when we say a leading indicator, whereas a lagging indicator would just be something as simple on your charts as like technically a moving average is considered a lagging indicator because it's based on past tense data, historical data. Now you can use a lot of what are typically classified as lagging indicators. You can still use those to get a forward look at where you think the market's going, but by proper definition, most of what you put on your charts in the context of technical indicators are in the category of lagging indicators, things like moving averages, things like Fibonacci, right? You're looking backwards. Anything where you're looking left is basically a lagging indicator.
Perfect. That's awesome. All right, there's a couple things in the chat before I jump into what I'm going to. A lot of people hit their goal already. Yeah, I did. I traded my daughter's live account. She was out 2%. This morning when I woke up. So I'm super excited about that. And the decision to do that was the right decision. So I'm already done for this week. I'm trading my live account in a different way this week. So I'm not using TradeRinger on it. Not that, it's perfectly fine. Don't take this the wrong way. I just am trying something different. So I see one thing that I definitely want to address in here because I want our goal collectively as a group of people should be to do a few different things. But one of those things is to elevate our education, elevate our level of understanding about what is actually happening in the Forex market. I've been reading this book, Why Trade Forex, and it's just super, super interesting. As to the reasons why. And there's so freaking many that make it good, but I want to make sure that everybody understands the following thing. So Hernan posted CHF pairs, 24% in drawdown to 0% in 2 days. Okay. Please know, you guys, that is a result of the market movement. I'm not trying to put down anybody's piece of software. The software needs to know how to do that, but without the big news that we all just talked about, okay, that does not happen. While we all hit our goals early this week, that's a thing of beauty. That has a lot to do with the way the software was seeing the market reacting to things and all of that. But if you don't get market retracement, you don't get 24% in 2 days. You just don't. So to understand certain things about the market is super important. Here's what you can get, and I know Ryan's going to piggyback on some of this, I hope. All right, is that imagine not having the right mindset and tapping yourself out at 24% when a retracement was right around the corner. Dude, this is why not everybody, this is why a majority of people don't make it in Forex. They get emotional about that. And I get it. All right. I completely understand it. But look what happens. And like Ryan just said, it happens on the drop of a dime, dagummit. All right. Another way that Ryan's trading live and he told you he's trading some manual trades. I'm doing something similar to that. And it was way up last night, and then the market took the curve while I was asleep. Now I had everything set to 0, and you know what that will mean. But I was already in some, so that didn't matter. And they didn't fare well, but they went completely against the trend because of what happened with the coronavirus and all these things that Ryan's talking about, which, you know, there's no miracle here, right? I mean, you can use these leading indicators like Ryan's saying, and right now there's, you know, we're getting that retracement on the US dollar. But please understand there's no magic in Forex. There is no magic. It doesn't matter what EA we're using. It doesn't matter what, you know, what there is you going out and learning why things happen the way that they do. That's way more.
Yes, I'm so glad you said that. So like, let's do this, right? So Hernan says CHF pairs 24% DD to 0% DD in 2 days. So what were those pairs? And let's help you understand why that happened. Or maybe you can tell us why you think it happened if you're willing to. Or maybe someone else who sees Hernan put his specific currency pairs into the thread. I love what you're saying, Alan. I couldn't agree with you more. I think we want to have admiration for our software, but we don't want to be mystified. We don't want to be mystified by it. And I think that probably there is a tendency to think that the software is making the market behave a certain way. That's never going to be true.
Right.
And so I love the path you're going down, man, for sure. I think the more we can help people understand why is the market doing what it's doing, and then therefore, you know, you'll make sense of why your software actually produced the result it did, because you'll see the explanation in the way the market moved.
Yeah, so Hernan, can you pop those pairs in there? Maybe we can take a look at them on TradingView or something. And I'll tell you what, while he's doing that, I do have a little short slideshow that I want to share with everybody about some very basic things in Forex, and we'll jump back to Hernan's situation. This is literally one slide, but it's not bad. All right, so let's see. Let me share my screen. Yay. Pop this, run this. All right, so this, you guys hear us talk about this all the time, and at the very fundamental level, this should be something that you should definitely want to understand. I'm not telling you that you need to go out and chart and do all the stuff that, you know, Ryan loves to do. We got together yesterday and, you know, and had some fun. But we're talking about support and resistance basics. You hear it all the time, support and resistance. And these are the most widely used concepts in Forex trading. So I got a couple of things on the chart here that we're going to use the chat box. And Ryan, you're going to have to monitor it for me because I can't see it when this thing is full screen. So here we go. So this is a market, right? Can somebody tell me, there's three different words, they all mean the same thing, what kind of market this is? Three very specific words that describe what this market is, and we've talked about them before. Can anybody in the chat box, I promise to send you a gold star like my second grade teachers, Mr. Waterman used to do. At least once a year I got a gold star, okay? Can anybody tell me?
All right, Nancy. Nancy was the first one to get one of them correct. A bull market.
Yay! There's one answer.
Let's see, Nan. I'm going to give Nan credit. She started with the word bull, but then she added the word ascending. So
okay,
that's good. That is
that's the fourth word, actually.
Yep, that's an ascending market.
Right. Not one that I was looking for, but it is. All right, I give you a clue. What kind of, if you wanted to catch this market, what kind of trade would you place? Anybody get it?
No, I was waiting for that one. That was the next one I was waiting for. I thought somebody, there you go. EJ said buy.
Buy market.
You got your hit. Buyers. Yep. Buyers market. Ray. Very good.
So it's bull, buy, ascending. That's a good one. I left that one out.
Yeah, that's really good.
So here we go. Here are the three words. Long. It's a long market. Bull, long, sell.
We'll give Nancy some credit too. She just threw an upward trend, which is accurate. That's good.
That is absolutely true. So that's the kind of market that we're looking at here. This would be equivalent to a line chart. And I can tell you this, we always look at candlesticks. Candlesticks have way more information than line charts because they show open and close. They show, wicks up, wicks down, and things like that where price are going. If you really want to learn support and resistance, change to a line chart. And it will really help you identify areas of support and resistance. So if we were gonna identify areas of resistance, where might those appear on this line graph? Can anybody answer that? See what we get.
This will be a good one, man. It's too bad we can't it'd be fun to have like an interactive chalkboard to see. So
yeah, I'm trying to figure that out with my iPad Pro.
It'd be fun for people to get to come in and try to mark them.
That'd be great. Can anybody tell me where those might appear?
I'm watching the chat. So you're asking for resistance levels, right?
Yeah, resistance levels. Where are those on this little line graph? Anybody know?
Yay, Nancy. All right. Nancy got it.
Got it?
She said support is the bottom, resistance is the top. And in an upward trend, you are spot on.
That is correct. So these are all resistance levels right there.
Bingo.
Okay. And these are all support levels right there. Exactly what Nancy just said. So guys, Nancy, you're listening and I love it, and you're learning, and that's even better. So let's just talk about this for one quick second. Okay, when the Forex market moves up and then pulls back, that's what it is. Okay, the highest point that it reached before the pullback is now called resistance. That's how resistance is formed, right? By the same token, as the market continues its upward movement, before it moves up again, the lowest point that it reached before it started back up is now called support. And you hear Ryan talking about support and resistance all the time. Now, on a line chart, this is really easy to spot. It's a little more complicated on an actual candlestick chart. And here's the thing: support and resistance is not an exact number. If Ryan and I were looking at the exact same chart, we'd be in the same area, but probably not with the exact number. So this is important. This is an important concept to remember. Resistance and support are in no way a fixed thing. Okay, they're continually forming and reforming as the market oscillates over time. There's that word, oscillators. What's an oscillator? Oscillators are cool, all right? But it is a form of indicator. So the market is oscillating because it's what? Going up and down all the freaking time, right? I mean, if you were trying to shoot that rabbit, if it would just hold still, it might be easier. Bless you, sir.
Thank you.
But the reality is it's changing all the time, and you need to be able to support these levels. Now, here's a couple of tidbits that you can put in your cap, and this is the end of this lesson, but a couple of key things to remember about support and resistance. First of all, when price action, okay, however price is acting, price action passes through resistance, then resistance could potentially become support. Ryan has illustrated that a number of times on TradingView when we're looking at sandwiched, horizontal lines that would indicate that resistance has become support, and so on and so forth. So that can happen all the time. And this is probably key. This is really key. The more often price action tests a level of support or resistance without breaking it, the stronger that area of support or resistance is. So when you're talking about support and resistance on your charts, right, then oftentimes it would be good for you at starting out to switch to a line chart. You can do that in your if you're doing it on your MT4, it's super simple. In fact, I'll show you just because that's all I have on this. I just wanted to touch on that because every week we want to give you something to study, something to think about.
Good, man. It's good stuff right there.
Thanks. Let me show you how to easily switch to a line chart, since you see that magnificent phrase, weekly goal reached. I love it. But switching to a line chart's easy, right? We just go right click on the chart, go to properties, and then go to common, and then switch to line chart, and then say, okay, there's a line chart. It's ugly, but you can easily see areas of support and resistance because there isn't all kinds of noise on this thing. So Don't like them myself, and I've gone past the point where I needed to use them to learn this stuff. But guys, while we're in here, I'll just show you a couple of spots, right there, right where my mouse is. Look at though. Okay, now this isn't exact again, and the numbers are never exact. But look at this. Okay, so it's harder to do on this than it is on freaking TradingView. But today I promise to drop the dime on TradingView. But if I move this up to the closes right there on those two deals, let me see if I can drop I'm not good enough in this particular piece of software to do this, but you can see it. But look what happened. It is a line of support because look, we traded above the support line here for a whole bunch of times. And then guess what it did? It came back down and tried to test it to get maybe down to this next support level down here. Couldn't do it, bounced off of it, boom, really bounced off of it, right? And so this is to me, this is a really good area of support. And this is so that to take this one step further, look at that, 2% on the nose too, okay? To take this one step further, this is what guys are watching for. This is what traders are looking for to determine trend reversal. And this is one of the things in the book that the market said, okay? If you're buying and holding stock and your company takes a dump like Apple did this morning and says we're not going to produce as many iPhones as we thought we were going to because of a virus, and you're holding that stock, what are your options? Nothing. All right. If it goes below the price you paid for it, you're losing money. One of the reasons to trade Forex is that doesn't matter. You can capitalize on a bull or a bear market. Super, super important. So anyways, to know that. But right here, let's just say that this candle would have closed well below this line of resistance or support that we see here. That would be, we don't want it to be a fake out, but that could be an indicator that the market was going to continue in a downward trend. But it bounced. It tried again, and it bounced. It bounced here. It got a little bit below, but it bounced here, and it really bounced there. And that should have been an indicator to anybody that, hey, this thing's going to continue to go in the other direction, and it obviously has. So there is a little bit of spotting what's going on there. So don't know if you want to add to that, Ryan, or it was pretty clear on that, I think.
Yeah, I love it. Okay. And it's funny because that's, you talk about what traders look for, and that's exactly what I'm doing with my manual trades. I'm up 10% on my account today, right now, open trades. 10% positive, but I'm looking to clear those levels like you just showed, and then I can move to risk-free, and I pile on my next trade, right? Like, so you scale out. I don't want to get off on a complete tangent, but I'm just reinforcing what you were showing, because as the market moves the direction that traders expect, they use exactly what you were just displaying to make the next trade, whether it's going for you or against you. You use those levels to continue to either add to your profit or cut your losses. Or, I mean, you could, if you knew nothing more than what you just showed today, literally support and resistance levels. And then when we talk about these other tools, that's just to kind of reinforce, where you expect price to possibly react, like take support resistance and then put a Fibonacci on top of it, or put an Elliott wave on top of it, or then you're building your own confluence. But I agree with you. You started at square one, right? Learn trend direction, learn support and resistance, and you can go make a lot of money as a manual trader if you wanted to.
You really can. Yeah, you really can. And, so I don't know, some of you would have been on this call, some of you were not on this call, but on Saturday, Hunter Burkett brought something up that was absolutely spot on. But the reality is, if you don't know these basics, you can't do what he brought up. You've got to learn this. I mean, imagine this. Imagine you're in a 22% drawdown and the market isn't going the way that you want, but you have the ability to trade that account manually with your trader off and dig yourself out like Ryan is doing right now. Now, I don't know that he's digging himself out of anything, but 10% is 10% all day.
No, I cut some losses today because they were going the wrong way, and now I'm not really revenge trading. I'm really, truly, the market's changing trend. And so I would be crazy to stay and lose. You cut your losses, right, appropriately, and then you get in the direction of the trend and let it roll. And with some simple use of something like a Fib tool, Fibonacci, I'm like, oh my gosh, there is just easy pickings in the market right now because we have a lot of distance from where we are on most of the major pairs like USD, JPY, Euro, USD till we get to our major, kind of primary fib levels, our 38.2 and our 50. There's just an enormous amount of money on the table, man. And I see where the market's going. And so I want
some of that up.
Yeah,
Snap
for sure. I mean, this,
all right.
Yeah.
We're going to move on to the questions and bring this plane in for a smooth and perfect landing. So here we go. Don asks, there is a question in this. I have a great, thanks for saying that. I have a great retracement going on from as high as 14% drawdown last Thursday to close this week at 7% drawdown. After listening to our great Saturday Zoom, I decided to keep my positions open with the same currency ring. Yay! I'm glad you came to that conclusion. I am now at 0.38 drawdown. Things are looking very good this week. On top of that, my balance is up $70 over its high. Question. Last week's was all sell trends and sell counters, zero buys. Is the trade ringer working in a better outcome scenario when it is a good mix of buy and sell positions versus all one or the other? Okay, so basically you're saying if you're in all sells and all buys, does it work better than if there's some sells and buys? That's a great question. And there's a bunch of ways to look at this, okay? First of all, depending upon the chart that you're using, and if you're in a daily chart, okay, you got to understand this, and I'll go here, and Ryan, I'm probably going to rely on you for some of this. All right, but this is a USD JPY daily chart, right? So let's get some of this mess I have out of the way. Let me do this so we can get over here, okay? So you guys can use this tool if you're not using, you know what? Never mind. I'm not doing this. I am going to do something different. I am going to attempt to get you guys used to the fact that if you're taking this seriously, you should get a TradingView account.
Yes, sir.
All right. So let me just resume. Oh, well. All right, let me know if you see the right thing I want you to see.
I'm still seeing your VPS. Oh, here we go.
Yeah,
there
it's
you go.
doing something really weird. All right, share screen, share desktop. And there we go. TradingView, awesome. That's all I can say about that. Okay, we're going to go to a chart. We could pick any one, but we might as well go right back to the one we were just looking at, which is not the S&P 500, but USD JPY. And we can pick any one of the brokers, right? And I'm gonna, oh, why do I have this thing so massive? I'm just gonna go to my full screen. But when you're trading a one day that you see up here in the corner, please note, and I'm not trying to say anything other than what I'm saying, each one of these is a day, right? Okay, now there's a method to my madness here. Okay, so this is Sunday. Let's just pretend here, all right? This wasn't Sunday, but let's just pretend that this was Sunday, okay? Then Monday, then Tuesday, which we haven't seen yet. But just for the purposes of what I'm trying to illustrate here, okay? So let's just say that right here, and this is exactly what you would see. Let me actually go out of full screen because I need some tools. I need tools, baby. All right, so we're going to use a horizontal line here, and I'll place that line right there. So let's say right about here, Trade Ringer started placing sell trades, okay, in the middle of the day on when the market first opened, okay? So here's the part that wigs everybody out. Well, why the heck wouldn't it have placed a buy trade? I mean, the market's going up, right? Okay, because there are 14 billion and a half trading styles. Trade Ringer's trading style is to catch the retrace. It's looking for the swing. It's looking for a counter trend. I like that word probably least of all, or that phrase, rather than the swing, because one happens here, right? So if we have let's say a trade right here, I'm going to draw another one, a trade right here, draw another one, because that's the level, a trade right here. All right. And that's our 3 levels of trade. The next day, when the market starts going the other way, what does TradeRinger do? It catches all the money. That's its trading style. Go the wrong way, or what appears to be the wrong way, anti-trend, because it's looking based on what it knows, based on what it sees, based on the past, all right, based on history. It's looking for this swing, and guess what? It swung, and it swung hard. And hopefully that illustrates to you what a swing trader is looking for in that case. So I don't know if it's better one way or the other, but the way that TradeRinger trades, that's the way it trades right there. Ryan?
Yeah, I think I don't know that I necessarily have a lot to add to that. If you look at that big long green candle, I'll tell you why things can get uncomfortable sometimes. Is because one of the things that the TradeRinger is using is the average daily range, or the average 2 range. Now, this is a USD JPY. It typically has an average daily range around 450-ish, 450 points, 45 pips, 45 to 50 pips for the day. Typically, over a longer period of time, that's about what you would see. And so, where you have to have this thing called patience we talk about, which just kind of goes back directly to Don's question. When it behaves within the average daily range, it will get the oscillation that TradeRinger uses to make money. When it gets outside the daily range and keeps moving and keeps moving and keeps moving, TradeRinger looks at that as adding the probability that a retracement is coming, which should answer for all, why does it keep placing trades in the wrong direction? Because if the average daily range typically stays within a certain number of points, the further you get outside of that, the higher the probability that it has to come and give a retracement, which is why it continues to want to place trades in that same direction. Just so you guys kind of understand that. And you can see it on those 4 candles, just the 4 most recent candles on Alan's chart there. The one big green one there, the 4th from the far right, it got way outside of the ATR. There it is. I almost called it to the number. What did I say, about 450? 449. Yeah. Boom, yeah. Anyway, yeah, we're not dorks. We don't study this stuff ever. So
there's a question in there, though. Can anybody say what 450 points actually is?
I gave the answer if people were paying attention. I mean, we'll see if they caught it. Let's see. I'm looking at the chat.
This number right here that you see, that number, all right, as we're, oh, look at that. That thing is jammed. How do you turn points into pips? Divide by 10.
Yep. There you go. Clint got it. Hernan got it. Rebecca got it.
Perfect.
45 pips. That's correct. Good job, everybody. Good job. So anyway, that's all. I don't really have much to add other than, I mean, you can see this is such a great illustration of why people are out of their drawdown, of why they hit their goal early this week, of why trades from last week that were in drawdown got erased. And it also is a great illustration of why, when the market does sometimes go, off the range, why does TradeRinger continue to place those trades what people feel like is the wrong direction? It's really not. Probabilities based on average daily range, which is one of the primary drivers of TradeRinger, probabilities suggest that those 2 big red candles are almost inevitable. Now, not always, but probabilities are very high that when you get to super crazy off the charts green candles, inevitably there is a big above the average daily range red candle as well to bring us back into what the average daily range might have been in that first green candle, right? We got back into that range, which is what allows for those trades to close out in profit. So hopefully that makes sense.
In a lot of cases too, so that you guys know, maybe we should share, we'll share this maybe Wednesday. But somebody asked a question the other day. All right, if 1 million users were using TradeRinger, let me just put it to you this way. If we had 1 million subscriptions on TradeRinger and everybody was trading, say, a $10,000 account, we probably couldn't move this candle. We don't move the candle. Okay, because someone said, well, would that, I think it was Don maybe even, would that affect? No, it wouldn't affect anything. That we're playing in an ocean that's so vast, we're somewhere buried in the Mariana Trench underneath a cliff. We're not making a difference, okay? We don't cause this to happen. What does cause this to happen are gigantic institutional traders trying to move the market to a place so they can do what? Capture everybody's stop loss.
That's right.
That's what they do, okay? So they move the market to a place where all of their money's over here too. And they're just nailing all the retail traders that are going, man, let me go with the trend and stay in just a little bit longer because I'm greedy or because I'm needy or because I've been smoking too much weedy. Who knows? Right? But they stay in just a little bit too long. And so TradeRinger is trying to follow that institutional trader and going, okay, price is getting pushed up and out of the way. We know that these guys, it really is a genius piece of software. But here's the reality in the reading that I was doing. Okay, now these guys are trading massive accounts, millions and millions and millions, sometimes billions of dollars. And some of these guys that have gotten the accolade on like Investopedia and things like that, they make 30% a year. Okay, they may not trade a week if they don't like what they see. These guys are the top of the top, making 30% a year. Now, of course, 30% on, a $60 million account is fine and dandy, but that should tell you, that should be a clue, all right? Our 2% goal every week is massive. It's high. It's good. So anyways, I'm done on that. Let me get back to something. Stop my share. And okay, so hopefully that answers your question. I don't think that it's better one way or the other, but it reads what's happening. It's attempting to and place trades so that it can capture it on the way back down. Okay, you're talking about the stocks being way down. My account has retraced and is up 1%. Will this stock news cause a big problem through this week, and should you close out? All right, there's the yes, yes, and yes answer, the maybe, maybe, maybe answer. That's entirely up to you. I can't give any advice there, but there's a reason why, and we've said it multiple times during this, that you're up. It's because of the market movement, right? And you might want to be happy with 1%. I don't know.
And let me say this, because we've also said this many times. We are not privy to the exact precise elements of TradeRinger's algorithm where it's determining trend direction at any moment in time. We have some generic points of reference like moving average and average true range and some of the things that we share with you guys. But as a drug, for every, what goes up must come down. For every action, there's an equal or greater reaction. Here's what I would tell you. When the Dow moves 907,
whatever it was,
whatever that was, right, points by 8 a.m., and it's currently sitting at a $949 move, I would tell you, unless you really know what you're doing and you're manually trading, like I don't say I really know what I'm doing, but you can see me looking constantly. I'm watching my dollars on my mobile app. I'm up about 20% on my account right now. I'm not being greedy. I'm literally watching the trend. I've got indicators on my big monitor right here. I'm paying hyper attention, right? So there's this is what I'll tell you. There's a high probability that and I'm in risk-free trades, by the way, Alan. You'll be happy to know I've moved my stops to my entry. So I don't technically have to be watching really as much as I am. I'm in it because that's a pretty great set of trades to be up 20% in your account for the morning. But I am risk-free, which I'm stoked about, right? I move my stops to my entries, so even if they turn against me. But this is my point. Unless you know how to do things like that on TradeRinger, just be aware. Like, I'm in risk-free trades because I'm aware that what goes up must come down. The market could very rapidly turn against me right now, and my 20% could get erased like that. Now, the good news for me is I won't lose money because I have my stops at my entries. But if I was, if I was, I'm not trading anymore with Trade Ringer either. I'm done with Ringer for the week. But if I was, and I had a gain, which I already have done that, just like you guys, I would, I'd be reticent of the fact that what goes up must come down. And when you get this dramatic of a move in the markets, usually there's going to be a reactive move, and it's only Monday morning. And so we've got a lot of days left this week where that reactive move could come. It could come in the London session tonight. It could come tomorrow. It might not come till next week, but it could come. And when it comes, it's not going to be in your favor, because if the direction of the market right now got you in a good spot, the retracement, the reactive move, has a high probability to work against you. Whatever those trades are, whatever your pairs are, whatever your trade direction is, just understand that this dramatic market move that got you to a good spot can have a reactive move that gets you not in a good spot. And so just make sure at whatever decision you're making that you're acknowledging that fact.
Awesome info. And I love the next question. Carol Sewell asks this question. It's a great question. Okay, we've been taught not to talk money, but to talk percentages. Okay, if there's a $2,000 account and a $22,000 account, and both are set at the same percent for the week, let's call it 2, does it take the larger account longer to meet the goal? And the answer is not necessarily. It could. Now, I will tell you this, if you are trading with settings of a $2,000 account on a $22,000 account, the answer is an unequivocal yes. Okay, there's no way that you have, and Ryan has said this in the past, you don't have enough horsepower in the car to make it up the hill. Okay, if you're trading, say, 01 lots on a $2,000 account and it gets to 2%, it won't even remotely be near 2% on the $22,000 account. So a larger account, look at the larger account as a heavier train going up a hill, right? The larger account weighs more, so it needs more locomotives at the front of the train to pull it up that hill. Those locomotives are your lots, okay? Not necessarily everything else. If you found a sweet spot with, your range between trades being at 21, 24, 18, wherever yours might be. All right, if you found a good sweet spot of, your multipliers, your level range multiplier and your lot size multiplier, those things aren't really going to make a difference if it's a sweet spot on the account size, but the amount of gasoline you're pouring on the fire makes a huge difference. So, and here's what I would say further to that question, and that's this. Not necessarily are the multipliers of a $2,000 success story equivalent to a $22,000 success story. What do I mean by that? Okay, if you're able to consistently hit 2%, all right, on a $2,000 account with an 01 lot size, that might say to you, well, for every $2,000 I have, maybe I should trade 01. All right, that makes logical sense. I mean, that's a logical progression, right? So how many of those are there in a $22,000 account? Well, there's 11. So if we took 0.01 times 11, that would say I should trade a 0.11 at $22,000 to get the same result. Let me just say this. That's a great starting point. And that's period, end of sentence, end of chapter, end of everything. It's a great starting point. It makes sense. It makes mathematical sense. Doesn't mean it's going to perform the same way.
Yeah, a lot of times, you guys, the reason you see small accounts seem like they're performing better, because, and I know I'm repeating what Alan already said, but you can't get any lower than a 0.01. So the lot size is disproportionately larger on smaller accounts, even when they're at the lowest possible lot size. You can't go smaller than a 0.01, at least not at LQDFX. And so you can't reduce that ratio any more than what it already is. And so ultimately, anybody who's running more conservatively than a 0.01 for every 2,000 is going to have less horsepower, just like Alan already said. And so that's why a lot of times smaller accounts seem like they're performing better. They're actually in a riskier situation than other accounts with that lot size to balance or equity ratio. So
awesome. All right, so we have one last question. We're coming up on the hour, so we're going to go ahead and clock out. We have another call to make today. Ryan, you're ready for that, right?
I am. Yes, sir. I'm ready.
Okay. It says from Jim Widman, if we change our charts from daily to weekly or monthly, does TradeRinger change its strategy? Inevitably, yes. I mean, without a doubt, it would have to change its strategy. I mean, it's more conservative, but I don't know of anyone that's tried it. A good way to look at this, Jim, is to do this. Okay, I went through teaching you the other day, and here's what I would like for you to do. Go to tradingview.com, open up some charts, make sure you're looking at candles, right? And then go to a monthly chart and look at the candlestick patterns, right? And draw something on that chart, you know, like a box or something like that around a single candlestick, and then back it down to a weekly, and you will see all of the candlesticks that made up that month. Okay, you're going to see 4, you know, maybe 4.33, I don't know. You're going to see 4 that made up that month. And then when you go back to a daily, you're going to see 31 candlesticks that made up that month, if it's a 31-day month, right? Depending upon where you're at in the month. So by backing down, you're getting a more granular look. By going up to the week or the month, you would really only want to use those charts if you were trying to enter, you know, a trade that you intended on staying in for 7 months, you know, 7 weeks or 7, you know, that's what you would want to look at, is those higher time frames to see where things are going. And there are the big institutional traders, that's normal. But they have direct feeds, and they're not paying swap fees, and they're probably unlikely paying commissions and things like that, because they're not using a retail broker like we have to. They're institutional traders. They have their own feed, right? And so that's the way that works. But yeah, it would change the strategy. I've never heard anyone do it. But you, by the same token, you can take your daily and back it down to 4 hour and see what makes up that daily candle. So it's cool. I got nothing else. You got anything else, Ryan?
No, senor.
Right.
Yeah.
All right. He said cool gun. All right, guys, have a blessed rest of the day. Don't get greedy, and you'll never be needy.
Ooh, I like that. That's a hashtag right there.
That's a hashtag.
Hashtag.
All right, see you guys. Bye.